Hey guys, so it seems that the financial industry has managed to cast an illusion over the public, making us believe that only the rich and the wealthy are able to invest for their future. For years, when you thought about investing, you thought about the fat cat bankers sat behind the screens, watching numbers go up and down and retiring early to the Bahamas. Now though, thanks to technology, this illusion has been broken, and that you and I can go through and invest ready for our futures. So today, I wanted to go over a few things that we have the options to invest into and how we may look about doing that. Hey guys, hope you're doing well, and today I wanted to go over investing, cover the things that we need to know, such as how we can get involved, what we can invest in, and how we can do it. So the first thing to ask would be, what is investing? And investing would be essentially buying assets that will help you in the future, whether this is through buying assets to sell later, or for those assets actually funding you throughout your life. So now we know that, we should probably start with what is an asset. An asset, as described by the Oxford Dictionary, is a thing of value, especially property, that a person or company owns which can be used or sold to pay debts. So that's an asset. Fairly easy to understand, something that you can buy, acquire or have that you can then use to pay off debts or sell to pay off debts in the future. We also have asset classes. Asset classes are essentially just groupings of various types of assets. This could be cash, stocks, bonds, things like that would all get acquired into their own group. So the main asset classes you're going to come across will be cash, which is obviously cash. You've also got equities, which is buying parts or shares in companies. You've got real estate, which is obviously houses, buildings and the like. And collectibles, this may be your Pokemon cards, your vinyls, anything that you've bought that may add value and you think you can sell in the future. And then there are a few others such as commodities, but we'll be touching on them in a separate video in the future. So let's run through cash. You know what cash is, everyone loves cash. You like it in your pocket, you like it in your wallet, you like it in your bank, and some of you may even keep it under your bed. It's clear when you compare cash to the definition of an asset, it matches the groups. You can use cash to pay off debts. You don't need to sell it unless I suppose it's in another currency that you need to transfer, so you're selling it from one currency to another. However, you can use that to pay off your debts. The problem with cash is all the time that you've got it, even in high interest bank accounts, you tend to be making around a 1% interest at maximum on your money. The problem with this is slowly but surely, inflation creeps up and steals your money. On average, there's an inflation rate of 2% every year, and this is why you used to be able to buy Freddos for 20p and now we're buying them for 30p. I personally try to keep my cash to a minimum and only keep what I need throughout the month. The main reason for this is because I can then put that money into higher interest savings accounts and other ways of making interest which outweigh the rates of inflation. But I do obviously understand the benefit of having cash and the usability and the quick trade value of it. Cash itself is very liquid and very useful, however I don't like to keep large sums of it on hand at any one time. Generally, to store my wealth, I prefer to use stocks and shares, which brings us on to the next asset class, which is equities. So buying equity is essentially buying shares and parts of a company. What you do is you buy in and you get a slice of the pie. So any profits they make, you gain benefit too. Under equities, there are some other terms that we should probably go over, such as what is an index? And all an index is, in layman's terms, is a group of stocks. These are generally grouped under terms you may have heard, such as the FTSE 100 for the UK, which is a list of the top 100 UK stocks at the time. This includes companies that you've probably heard of, such as AstraZeneca or Barclays. And the other example would be the S&P 500, which is a collection of the 500 top US stocks. Now that we know the difference between stocks and indexes, it's worth having a quick look at ETFs, or exchange traded funds. What an exchange traded fund is essentially a pre-built portfolio that you can buy into the same way as you can buy an individual stock. However, rather than just buying a section of Coca-Cola, you would be buying a section of up to 100, 200 companies. The amount of companies would depend on what ETF you're buying, and most ETFs do follow one index or another. These ETFs work basically the same as stocks, except rather than buying one, you're buying multiple. If any of these companies pay out a dividend, you will get your percentage of that dividend back to you through the ETF as well. ETFs work essentially the same as shares, whereas instead of buying into one company, you're buying into multiple, but these prices do fluctuate from day to day, so you will see a trend change throughout the time. The other option, if you didn't want to use ETFs, would be to actually buy your stocks individually. As I said before, you could, for example, buy shares in Coca-Cola. The advantage of doing this is you've been able to concentrate your value into one particular area, such as Coca-Cola. Therefore, if Coca-Cola does really well, you will get a lot of a payout for that. However, on the other hand, the disadvantage to doing this is if Coca-Cola had a massive incident, your value could drop massively and you haven't got any safeguards against that. That's why most portfolio managers do suggest to diversify. Essentially what you do is you'd buy a couple shares from one, a couple shares from another, and a couple shares from another. That way, if one of your companies failed, you've still got the other two that will be keeping you afloat. So that's how investing in equities would work. Essentially, you're buying a slice of the pie from a company or a larger pie full of smaller pies, and then you get the benefits of doing that. This could potentially be through share price inflation, which would be where you would buy it at 100 and then sell it for 200. Alternatively, they may pay you dividends, which is where they allocate a section of their profits to pay out to their shareholders, which you would be one of. Now, moving on, we have also got real estate. Now, most people know what real estate is. A lot of people think of it as houses, streets, and things like that. But real estate does fall down to any property that you have that you can make a value out of. This can be whether you're buying your first house and the value of your house goes up through time, which generally house prices do. Alternatively, if you were going out to buy a property, become a landlord and rent that on. Even just a garage in London that you rent out on a weekly basis can be a good investment. With real estate, it's possible to grow your wealth incredibly quickly. You can do this through purchasing houses and renting them out, or through buying one and then selling it at a later higher value. The disadvantage here is that you do require slightly more of an upfront amount of money, mainly for deposits in mortgages or the ability to buy the house outright as a whole, which is a fair sum of money for some people. The main advantage that you can get with real estate is mortgages and leverage. So you can put down a smaller percentage onto your house and therefore mortgage the rest of it and then rent it out for the difference, generally netting yourself a profit every month while paying off a mortgage so you own the house at the end of it. So that's essentially real estate. It's a really good market to get into, but you need the capital requirement to be able to do it. And if you can get there, you're probably making a good choice. Now we're going to move on to another asset, which I think a lot of people have, but I don't see talked about that often. And it is a bit of a hit and miss area, but that is collectibles. Now, near on all of us have over the years picked up a few things that we've put to one side and kept thinking that will be value in the future. I personally am a major culprit of this. I pick up a lot of things and then I resell them in the future. Most of the things I pick up tend to have a future value higher than I paid for them, but I can't always guarantee it. Whether this is comics or trading cards or anything else such as artwork, this is something that you've bought with the intention of it growing value as you go forward. And this can be the smallest of things. If you look at the moment, Pokemon is going mental. If you'd bought a box of Pokemon cards from when they first came out and kept them all this time, you would be sorted for quite a while. The main problem with collectibles is it's a slightly hit and miss area. You could be piling all of your money into something that you are sure is going to pull in value, and then 50 years later when you go to liquidate, it's worth half as much as you spent. Now, don't get me wrong, I'm not knocking anyone who chooses to invest in collectible manners. I personally collect a fair few things, evidenced by these trading cards that are above my head, but you do have to be aware that you can't guarantee the future value of the things that you're buying. Now, so we've briefly gone over everything we need to know about the different type of asset classes, all bar commodities, which as I mentioned, I will be doing in a future video, but it would be worth taking a quick amount of time just to have a look at how we can actually invest into some of these markets. So how would you invest in cash? Cash is nice and simple. It's cash. Essentially what you do is you can go and you can put it in a savings account, an ISA, or anything like that. If you are looking at an ISA, I have got a little video for you here, which you can watch and it'll give you a bit of information on how you can save cash in an ISA. For equities, I personally use Trading 212 as my broker for buying stocks and shares, mainly because they are commission free. I have added a link below if you'd like to give them a go and see how they work. Do remember that if you sign up through the link below, we'll both get a free share. So thank you for your support and let me know in the comments down below what you've got if you do take up that link. If you're interested in different brokers, we do have Free Trade who offer free commission trading. And if you're looking to, for some reason, pay for your trades, you can also go to one of the main streets such as Hargreaves Lansdown or Vanguard. For investing in real estate, that's quite an in-depth question and answer, so I'm just going to briefly touch on it. But I would suggest getting in touch with a real estate agent in your area, setting a budget and working out what you can do with it. You would be required to look at the varying amounts of rent rates and house prices in your area to make sure that it's worth it. And there are many channels on YouTube that talk about how to make profit from buying and renting out properties. If you're in the capital position to be able to do it, the easiest way that I can recommend would be to go to a real estate agent and actually let them know what you're looking for and get them to work with you. They're a great resource because they will just spend their time doing research for you. And for investing in collectibles, that's relatively straightforward. Find the niche that you think is going to grow in value or the thing that you personally would like to have and you think you may be able to resell in future, and then pursue that area. So you will know areas from your hobbies or areas that you're interested what may retain value, and I would suggest going after them, whether they're cars, books, or even vinyls. I personally have a very large amount of collectibles that I randomly have picked up throughout time, mainly because I like them rather than I intend to sell them in the future. However, I do always hold that hope that I'll have that one comic worth millions. Now, another part that I wanted to quickly touch on that I haven't mentioned throughout this video is self-investing. And what I mean by this is actually investing your money into your self-development rather than into financial development. This could be things through courses or qualifications in your subject area that could increase or give you a better job. Because what you have to remember is while investing money is good for the future, the more money you can invest, the better off you'll be in the future. The best way to achieve this is to increase your income while not increasing your outgoing. So what you want to do is try and make more money without increasing your living expenses. The problem that most people have is as you get more money, you buy more things, you move into a nicer house, you have more children, you do something that takes up that money. Ideally, if you can put all of that extra money into an account and start investing that extra money, if you're able to spend £100 a day that gets you a qualification and ends up paying you more over the long term, that is a lot more valuable for your future than it is just to put £100 into an investment account and leave it. But that's down to you. You know your situation better than anyone. You can have a look and see if you're going to make a lifestyle change or increase your career, and make that decision with all the information you've got. So everyone, thanks for joining me. Remember to hit the like and subscribe button, and please comment below, let me know how I'm doing, and any questions I'm happy to answer, and I look forward to seeing you next week.